It is a review of the project in totality. So I think when we have finished this extensive review together with our partners in PNW LNG, then we will then it'll be time to make a decision. For this year, I think Petronas, we have developed our budget based on a $45 Brent, and today the price is slightly above that. Range bound, but I think it's around today. It's around about $51–52. So I think for us, we think that the second half would turn on where the oil price would settle, but we are doing all that's necessary to prepare ourselves for any eventualities in the second half. So essentially, it will be up to the technical committee to make a recommendation to OPEC. For us, like I said, we will be prepared, and essentially, of course, we hope that whatever the arrangement is, the price will be better than what it is for last year. I'm sorry, but what it is for the first half. We hope so, but but we'll be prepared if that's not the case.
So Anthony, we're seeing then some of that production come offline in Saudi Arabia and in Libya. How does that change the scale here?
Yeah, good morning, Yusuf. Yeah, you're talking about geopolitical risk coming into the market as well, and we are seeing some of that. But really what we're seeing here with Libya and Saudi Arabia, it just comes down to fundamentals, and that's less oil on the market. Libya, again, is having problems with the ports. So just as they get up back to that level of about 700,000 barrels a day, they come back down as those ports close, and that brings oil off the market. And then yesterday, we were seeing information that Saudi Arabia was pumping, again, below 10 million barrels a day in March. That was from a person familiar with their data. And that's actually lower than a lot of the observing agencies were putting for them for March. So that's less production than was expected. In fact, most of us thought that the Saudis were increasing slightly their production, even though they were staying below that OPEC limit. We thought they were increasing slightly because they didn't want to do all the heavy lifting as they had done during the first 2 months. So this data yesterday is a little bit contrary to that. It shows, the Saudis are still taking more oil off the market.
Anthony, should we put the two together? The output level that they did back in January, and of course what you mentioned here, the likelihood of those of the extension or the rolling over of those output cuts. And I guess at this point, given those two, what is the likelihood that we will see those cuts extended?
Yeah, well, as Yusuf was saying, we've got the Saudis seeming that they will back a cut for the second part of the year. They want to take some more inventories off the market, and if this cut is extended, that will continue cutting into exports and taking some of those stockpiles off the market, and that's what will really have the impact towards the second half of the year. There's a lot of countervailing factors, though. We're always seeing a lot of sensitivity to headlines in the market when we see big numbers out of the U.S. in terms of whether it's the stockpiles increasing or whether it's production increasing from the U.S. We do see the oil price reacting on that. So we're going to be seeing that dynamic continuing, and it's the effort there of the Saudis and their OPEC partners to try to counterbalance that by taking that oil off the market. And as we've seen from also some of the crude pricing, they're trying to do that in a smart way where they can target some of those lighter crudes coming out of the U.S. and kind of tailor their cuts so that they stay competitive in the market while taking off some of those barrels that would head west where we have a lot of those stockpiles.